We've all heard about inflation, but what is it? In simple terms, inflation is the rate at which prices increase over time. So the more time passes, the higher the cost of those items. Another way of looking at this is inflation is a measure of the impact of the increasing price of goods and services on the buying power of money. So when you think about inflation, imagine a helium-filled balloon attached to an item you'd buy. As the balloon rises, so does the price of that item. You may have been able to afford this item before its price started rising or inflating, but now, maybe it just costs too much. Now that we know what inflation is, how do we calculate it exactly? A country's Bureau of Statistics, or Standards, will make use of a calculation called the CPI, or Consumer Price Index. Using the CPI, the Bureau takes the average cost of a basket of goods in a month based on weight and divides it by the cost of the same basket from the month before. This calculation is usually performed every month of the year, and the average is converted to a percentage. But you don't have to wait for the Bureau to figure this out. You could calculate your very own CPI month to month using the same formula. The inflation rate percentage is always positive because it measures the increasing cost of living, but this doesn't mean that its effects are positive. In fact, inflation can be seen as an indicator of economic instability. This is caused by the result of there being too much money going around in the economy, which leads to higher prices for goods and services. But what's this mean for you? Well, simply put, inflation is bad for your savings because it reduces your buying capacity. Luckily, there are assets you can invest in to offset inflation and protect your savings, such as bonds, property, equities, and other alternatives.